Good Christmas Eve morning and welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. What, you thought it would be off today? If you did, I guess you haven't been following my career for the past 20 years, and that's naughty, Santa says. I suggest you change it next year and follow every single thing that I'm doing and the Yahoo Finance team. I'm coming in hot with 5 things that have surprised me in markets this year. They are in absolutely no order of importance. I am surprised Nvidia stock is only up 40% this year, considering it's the dominant player for AI chips and the stock trades at a below market multiple. Shouldn't this be a triple-digit bagger for this year? I think it should be. I am also surprised that Amazon stock is only up 5% this year, an embarrassing performance against the 16% gain for the S&P 500. Amazon's earnings have been okay, and consumer spending has held up, yet the stock is being held back because investors don't think it's a real AI play. I mean, that's just mind-blowing stuff. I'm also surprised Lululemon, 1, is only axing its struggling CEO Calvin McDonald now, and 2, they're letting him continue to lead the company until January 31st, 2026. Lululemon stock is down 45% this year. Results have been terrible. An activist investor, Elliott Management, is now involved, and they will be shaking things up, I think, and very soon. I am also surprised consumer spending hasn't fallen off a cliff, given tariff-related price increases in a lot of categories found in supermarkets and in malls. Yet consumer spending grew at a strong 3.5% pace in the third quarter, largely a function of strong spending by higher income households. Main Street's still shopping at those dollar stores, and those stocks are at 52-week highs, I believe. And I'm surprised the S&P 500 isn't at a record high, or is at a record high, I should say. I'm not saying it should be 50% lower or some other absurdly clickable lower level, but from cooling job growth to near peak corporate profits, there have been reasons for investors to reassess, not live in a mindset of fear of missing out each and every trading day. Here in the Opening Bid Roundtable, George Say, Annandale Capital founder and chairman, and Sam Stovall, CFRA Research Chief Investment Strategist. Sam, starting with you. Good to see you guys. Thanks for doing this on Christmas Eve. Sam, what do you think about this Santa Claus rally here?
Hey, Brian. Well, Santa Claus rally, gives sort of an idea of the optimism that investors might have heading into the new year. It has added a bit. If we've been positive, we have added slightly to the S&P 500's average annual increase. If it's been down, we have taken it away, but we're still up about 6.5% on average. And the batting average has been reduced whenever it's been down. We were down the last 2 years, interestingly enough, and the only time since World War II that we were down 3 times in a row was in the late 1940s. So I think we have a good chance of seeing a positive Santa Claus rally this year.
Sam, in my head, I'm already looking past this week. I'm already looking for the next story. We come out after into the new year, that first week in January. What do you think it looks like, given we might have that Santa Claus rally that we're all looking at?
Well, the first 5 days of January is sort of a read on what is likely to happen for the month, the entire month. I think the January barometer is a much better indicator than the first 5 days because traditionally, whenever the market was up in January, it continued to rise about 86% of the time for the remainder of the year, and the full year, therefore, being substantially higher than all years since World War II. First 5 days, well, that's probably something interesting to talk about, but I'd rather wait for the full month to take place. Also this year, I'm wondering whether we do see some downward movement in the first couple of trading days because you have a lot of people who want to take some profits but want to defer the tax consequence until 2027.
George, a lot of viewers of this program, they have made bank. They've made bank in Mag 7. Not only this year, the year before, and the year before that, maybe even a couple of years before. They're sitting on a lot of gains, what I'm trying to say. What should they be doing right now with these gains?
Good morning, Brian. Can you imagine being a short seller in this market and trying to bet against the
terrible.
Mag 7 or the AI trade or anything? I mean, you get carried out. Short selling's been like the worst possible thesis on the market you could have the last 15 years, other than maybe going long oil and gas stocks. So I would not bet against any of these complexes, any of these movements. You want to talk about earnings growth, this market's got it. A lot of the other developed countries really don't. So betting against the U.S. has been a fool's game, and I'm certainly not going to be doing it in 2026. I'm going to not try to time the market. I'm going to try to stay in their state positions as is and just trim and reallocate as wisdom would dictate.
George, I just had a guest on, I'm doing double duty here. I was in the 9 a.m. hour, and they were making the case for healthcare. If you had to stack up these two sectors side by side, you got AI plays, you got the Mag 7, healthcare. What excites you more and why?
Yeah, I don't really like any of those the best. I think healthcare's seen a significant rally in the closing parts of 2025. If you look at Johnson and Johnson, which basically just lagged in the 140s to 170s kind of era for a long time, and now it's well over 200. You've already seen somewhat of a healthcare rally. If I was going to move chips around the table, I would stay focused on small caps, international, and believe it or not, even though I just ridiculed them, I'd look at oil and gas stocks. They're incredibly cheap. They're incredibly out of favor. And the risk reward of that is pretty compelling from a 1 to 2 year perspective, in my view.
Sam, George is the second person that has came on Yahoo Finance this morning and said they like small caps. Do you like small caps next year? And is the thesis to the street being a little more bullish on the Russell 2000, for example, that we're building lots of AI infrastructure in this country, people are going to have more money, the U.S. is going to do good, GDP is going to surprise the upside, and we're going to close out 2026 with more big gains?
Yeah, I think that small caps do have the chance of improving their position in 2026. I mean, right now, the S&P small cap index is still trading at a 35% discount to its 20-year average relative PE to the S&P 500. If the Fed is likely to be cutting interest rates again in 2026, we think they'll do it twice, once in the first half, once in the second half. That should benefit small caps. And if you just are a believer in reversion to the mean, then I think that certainly is a possibility as well. We don't see a recession on the horizon. And for stocks in general, I think that bull markets don't die of old age, they die of fright. And what they're most afraid of is recession.
What scares you about these markets here trading at record levels, George?
The fact that you've got an earnings yield of about 4% on the market, and that's where the Treasury security is. So your margin of safety is very, very low. Prices are extremely high. But markets don't die just because they're expensive. I mean, look at Alan Greenspan in 1996 with irrational exuberance and saying the market was way overvalued, and it doubled between then and 2000. So I'm not betting against this market. I'm enjoying the ride while it lasts, and I'm just trying to find things that make a lot of sense. And small caps make a lot of sense. And two of the mountains of the investment world are compounded interest and reversion to the mean. And we are going to see a reversion to the mean trend in small caps versus the unequally weighted S&P 500 index.
George, let me stick with you here because there's so many people that are focused on, are we in an AI bubble? I would argue we might be seeing the signs of a broader stock market bubble. And I'm not saying I'm right. It's hard to predict these things. Maybe don't have any clue what I'm talking about. But do you see signs that investors are too just anxious to own stocks here?
Oh, yeah. And you've got the percentage of American households that own stocks being at all-time highs right now as well. So are we rich? Are we in something of a bubble? Yeah, I would agree with that. But I would say that the fad trades, whether it's AI or space or defense tech or things like that, are in much more of a bubble than, for instance, healthcare, which you brought up earlier. It's a market of stocks. It's not a stock market. So you go look at stocks that have a bright future and are going to do well and that aren't so overvalued that your margin of safety is low. But you don't say, oh, I'm not going to own any AI. I'm not going to own Google and Amazon because they're spending too much and it's not real. You're balanced, you're diversified, you've got exposure to everything. You just may weight something a little higher that's much more attractive. And one other comment about small caps is the Fed is still cutting interest rates, and small caps have a lot more debt than some of these mega cap stocks. So they get a bump on their earnings just by redoing their debt and getting lower interest rates on their debt or having less debt to pay or paying it down. So they've got a lot of wins at their back right now.
Sam, you are a master of all things data. You've seen a lot of cycles. Do you see irrational exuberance in markets?
Well, as George had mentioned, I guess though in terms of valuations, by the end of October of this year, we were trading at 2 standard deviations above the mean for the S&P 500's PE ratio. You're looking at the Buffett indicator, which is the market cap of the S&P 500 divided by the nominal GDP. And normally we would get nervous between 100 and 120%, as we did before the tech bubble bursting in 2000, financial crisis in '07, and then the COVID bear market of 2020. but today we're at about 190%. So I would tend to say that yes, valuations are elevated, but they could last a bit longer. There has to be some sort of a trigger, and right now we haven't found it yet.
Sam, I think you could appreciate this. One of my favorite market indicators, and it's not one that I would argue has worked, is the Hindenburg omen. I mean, I used to write so many stories on this indicator and put like a burning balloon as the lead photo. It's just, I don't know, you brought up the Warren Buffett indicator, and it's taking me back to some of the early things I used to write about. George, I'm asking all my guests this week about surprises. What has surprised you about markets this year?
Oh, the resilience of the trade and the power of U.S. earnings growth. I mean, it's been astronomical, and I don't see the market having a huge bear market next year as long as the economy is growing 3.5 to 4%. I mean, this is astounding growth for an economy as large as ours is, and as long as earnings growth is in the 8 to 12%, you can levitate at 20 to 25 times earnings a long time if you got earnings growth that strong. Are you overpaying for the earnings? Well, yeah, you are, but that doesn't mean it's going to end. So the resiliency and the steadfastness of the market has really surprised me. And people saying, oh, I'm going to go short Nvidia or I'm going to go short Palantir. Well,
good luck with that.
The market can stay irrational a lot longer than you can stay solvent. So I would not be going after things like that whatsoever. I just stay long the market and enjoy it while it lasts.
Sam, has that resilience of the market surprised you too?
Absolutely. Normally, it takes 4 months for the market to decline into a correction or a decline of 10 to 20%. This time, it took us only 2 months to do that, or a month and a half. Then it takes about 4 months to recover from that near 20% decline. Yet this time, we did it in 2.5 months. We got back to break even by June 27th, and then advanced 11.5% in the 4-month period, which is exactly what history had indicated would likely happen. So it's very much been following the dance routine of the markets historically, and so that has been quite encouraging.
We can always be better students of the markets. Sam, do you have any investing resolutions for next year?
Yes, I believe I'm a big rules follower. Even though history is a good guide, it's never gospel. But one of the rules that I follow is if last year was an up year, you want to let your winners ride. If last year was a down year, you want to own the 3 worst performing sectors. Using this alternate kind of investment strategy, you would have added about 300 basis points to the market's return and beat the market 70% of the time. Obviously not a guarantee, but it's an encouragement that the market says it has further to run.
George, you have a resolution for next year?
I do. Don't time the market. Stay on the ride. Enjoy it while it lasts.
Well said. You guys just brought the heat for me on Christmas Eve. You always do. Thanks for being friends for Yahoo Finance. We'll talk to you soon. Happy holidays.
Thank you, Brian.
You too.
Coming up, the one thing Bill Gates thinks Nvidia CEO Jensen Huang could be wrong about. We'll be right back. 2025 will go down as the year where AI began to penetrate our lives like never before. Everything from ChatGPT serving up enhanced images of ourselves to a new chatbot causing your work friend of 20 years to get axed. It's clear this technology will change so much about the world over the next decade. I talked with Microsoft co-founder Bill Gates earlier this year on my Opening Bid Unfiltered podcast about all things tech, how he built his company, and what is coming down the pike.
Well, it'd be great for the United States if their process technology arm could be a credible alternative to TSMC and Samsung, which of course, they're trying to do that, but that, takes time and a lot of capital. So that it's a very, very hard thing. Technology is full of these cautionary tales. When I was growing up, IBM dominated the big computers. They were the computer industry. The computers the next size down were this company, Digital Equipment, which I learned and was very involved with them. And, so the fact that those companies, IBM's still around, but, IBM is tiny compared to Microsoft. And that wasn't the way it was, it started out. And so you have to be very humble about, wow, if you miss a turn in the road, you can be annihilated. Even Microsoft, as various things came along, like the internet, there were people who said, this is the end of those guys. They don't get this thing. And, we were able to surprise them and, even sort of take leadership in that area.
Why coding? Getting back to the book, what drew you to those early days of trying to write software?
Well, the immediate feedback you get when you put a program in and it fails or it works, that's so incredible. Most things, even if you write an essay, you wait, the teacher may have not understood how good it was. With math, okay, there's the right answer. But with the computer, this interactive nature of it, draws you in because you're like, okay, how do we make this faster? And, why isn't this working? One of the early problems I worked on was deciding when school classes would meet.
Love that story. It was a great story.
Go to lunch and a variety of things. It was a very complex thing that when the school first asked me to do it because of my math skills, I said, no, I don't think I can do that. But a year later, when somebody else had tried and not succeeded, I had thought, okay, here's how you do this optimization problem. So that was one of my first super complex programs, was deciding when the classes would meet and who would be in each of those classes.
It was amazing. As you're developing, I remember that story in the book on the school program, you really got no sleep. I mean, it seems like from age 12 to 20, you were operating on an hour of sleep a day.
No, I got more sleep than that, but adrenaline worked very well for me. That is one of the few things that I'll say age does, is if I want to be smart, I need at least, 6 hours of sleep. Whereas back then, I would stay in the office days at a time working on something and then, have to catch up quite a bit. But, I would sit at the terminal, and a few times I fell asleep with my head on the keyboard and the keys would kind of imprint on my skin and I, would look a little strange. But, we were very hardcore. And throughout my 20s, I didn't believe in vacations or holidays. I was kind of out of control, monomaniacal, in a way that definitely intimidated other competitors.
Where does Bill Gates sit on quantum computing? Nvidia CEO Jensen Huang talking about maybe it's a 15, 20, 30-year thing when it becomes really big. What's your view on it?
There is the possibility that he could be wrong. That is, there is the possibility in the next 3 to 5 years that one of these techniques would get enough true logical qubits to solve some very tough problems. And Microsoft is a competitor in that space, and I regularly review that work, and I'm quite impressed with it. But Jensen's correct, it could take longer. This is both in terms of how you build a quantum computer and what software you write that can solve problems that other computers couldn't write. There's some hard work to be done. Microsoft's been in this field a long time, Google, many players, but there are still some very tough problems, particularly the reliability that these qubits kind of collapse anyway. So I'm thrilled that Microsoft is making those investments, but there's a great deal of uncertainty there. In the meantime, the AI stuff, that's improving at a very, very rapid rate. And that, in a sense, it's more predictable that over the same 3 to 5 years, that will get extremely powerful.
What do you think about the pace of innovation at a company like Nvidia? I mean, they've really consolidated seemingly their position in chips. Of course, you have AMD doing fine work too, Broadcom, Qualcomm, but they seem to really be out in front. I imagine you have some thought on that, given how in front Microsoft was making software.
Well, if you say, what are the 7 most valuable companies in the world, put aside Aramco, there are all these tech companies, and the newest arrival to that list is Nvidia. And the fact that Jensen doesn't even make his own chips, that everybody has TSMC available, is all the more credit to him that at the design level, the silicon, the buses, the interconnects, the way they've done things is pretty fantastic. Now, I would say, I wouldn't want to be Jensen necessarily because, wow, other people are working on the same things. But, so far, he has stayed way ahead. And, Microsoft is an incredible customer, always, wanting to get as many of his chips as they possibly can, while at the same time, like other big tech companies working on their own AI chips. So I think it's pretty hard to predict, but right now, it's unbelievable how well he's done.
And we're going in a little bit into opening bit overtime here. On the chips, a lot of big tech players are starting to explore making their own chips. Of course, you have Google dropping Willow, Amazon looking to make its own chips. Is that where do you think big tech will ultimately end up? They want to control more of their own destiny?
Well, that trend has been both on the cloud server side and even on the client side. Apple has been at the forefront of that the magic of their products often involves the work they do for them all client side at the chip level. Microsoft started doing its chips for Xbox, 15 years ago or something. And now if you go into our cloud data centers, we have a mix of Intel, AMD, off-the-shelf ARM, but also custom ARM stuff that some we do ourselves, some we work with Qualcomm on. And so yes, if you want to optimize an entire system, often being able to work at that chip level and get rid of the margin at that level, that's the way you can build the best system. So it's that's a big challenge for people in the chip design business.
A very happy holidays from the opening bid team. I am so thankful for your support day in and day out. I'll be back at it on Friday morning because I love stocks and the stock market will be open for business. Market Catalyst is straight ahead.